And good evening, everyone. John Hutchinson with Traders Reserve's Millionaire Blueprint. I want to thank you for taking time out of your evening this Sunday to join me tonight. We have a great presentation for you. We're going to get started here in just a couple of minutes as we're still filling up the room. Hello, Jim. Good to see you. Hello, John. Good to see everybody already. We'll do an audio check, video check here in just a minute as we get underway, but we do have a pretty big crowd expected tonight, so I am going to try to keep tonight's presentation to about 45 minutes, not including Q&A. We'll stick around and answer as many questions as you folks have. Hopefully, those of you attending tonight were able to get your cheat sheet download in advance of tonight's webinar. That's essentially to help you keep up with the presentation as we go along, so that you sort of had a flavor for what's coming in tonight's presentation. And we'll be covering basically the exact same material that that you had in that PDF download. So so far, looks like we've got pretty good, almost 200 people already in here tonight. So great to have all of you. I hope you've all had a great Christmas weekend, and going to get started here. Let's take just a couple of seconds to do audio check, video check. Sounds like everybody can hear me so far. And feel free to let me know where you folks are from. As I like to say, I always enjoy discovering how far around the globe our webinars are actually reaching. So it's always an interesting exercise in geography for me. But for everybody, just a reminder that we are using a technology that plugs into Google Hangouts. So the audio and video does typically run on a short delay. So there will typically be about a 30-second delay from the time I actually start saying something to the time you actually get to hear it. But if you do have any issues with the webinar tonight, technical, audio, what have you, best thing to do usually is to log out, close the browser, log back in. If you used your email link to log in, just click that link again and get yourself right back in the room. That's usually the quickest way to get started. So far we've got quite a good crowd in here. Didn't get download. I was sent out an email, might have wound up in your spam mail. I sent it out about 2 o'clock this afternoon to everybody. But we've got folks from New Jersey, Florida, California, Bob from Yosemite, California, Canada. Welcome, Canada. Good to have you here. And Haley from North San Diego County, excuse me. And Alan from California. It looks like we got the whole California crowd. John in Michigan, and Karen from Nuremberg, Germany. Welcome, Karen. Nice to have you here. Stephen from Orlando. I'll actually get the opportunity to be down in Orlando in a couple of weeks. And Chris is in his house, so Chris is in the house. Welcome, Chris. Good to have you here. So if, Magar, again, if you folks are having any issues with the audio, it's not something I have any control over because we are tapped into Google Hangouts. So you may have to log out. It could be a Wi-Fi issue on your end. Anything is possible. So I'm typically hardwired into the internet when I run these, so I know it's not happening on my end. I don't have any breakups or issues unless AT&T suddenly completely collapses. And let's hope that doesn't happen. So, Johnny from Peoria, Denver, Houston, more Canada. Hector, welcome. Great to have everybody. Well, thank you for taking a second to tell me where you're from. I always enjoy that. I don't use it for anything. It's just it's always a pleasure to meet folks. And as I said in my email, I do hope I have an opportunity to work with you and help you reach your financial goals. But in order to get there, we need to get started. So let's not delay any further. Just a quick legal disclaimer, because it is required and it makes the lawyers happy. Forex future stock and options trading is not appropriate for everyone. There is a substantial risk of loss associated with trading these markets. Losses can and will occur. No system or methodology has ever been developed that can guarantee profits or ensure freedom from losses. That's called the Holy Grail. I don't have it. If I did, we wouldn't be here. No representation or implication is being made that using the Millionaire Blueprint methodology or system or the information in this presentation will generate profits or ensure freedom from losses. The rest of our disclaimer can also be found on our websites, tradersreserve.com or millionaire-blueprint.com. So if you're a fan of watching paint dry, grass grow, or water boil, you're more than welcome to read the entire disclaimer and our pilot policy on our websites. Enough of that. Let's start right at the top with the simplest of premises. Our goal is to turn 250 investors into millionaires. By the end of this webinar tonight, your goal is to be one of them. When we're finished, you will have, in its entirety, the only step-by-step investing plan that's specifically designed to create millionaires. That's why we've built it the way that we have. It includes 3 core components: a plan, a set of rules, and using the right stocks with those rules inside of that plan. So over the next 45 minutes, you're going to learn a unique investing plan that could turn $10,000 into $1 million in less time than it takes most people to pay off their car loans. In fact, it accelerates the growth of your money so that you can reach that $1 million goal in about 8 years or less. It also includes specific yet easy to follow rules so that you automatically secure investing gains and prevent portfolio wrecking losses. And it includes the one number that you must know so that you're always buying the right stocks and avoiding the wrong stocks. When you put these 3 components together, you will have a powerful yet safe strategy that grows your portfolio by compounding your returns every single month, not annually, monthly. But I want to be clear that this presentation is not about high-risk investing, penny stocks, day trading. It's not some get-rich-quick scheme. Yes, I have $1 million goal, but I'll show you how we'll get there. This is not Forex trading, very important. It also is not real estate speculation. We are and will be focused on investing in stocks and in the stock market, but perhaps not in a way that you might think. I know many of you may be concerned, because I know I am, that stocks have gone up so far, so fast in the last 5 years. You may be worried that we're in for another bubble. Or you're worried that stocks can't keep going higher even though they do. Maybe you're concerned about buying the top again like many people did in 2007, 2002, and 1999, only to wind up selling the bottom when the next market collapse comes along. And I have the same concerns, and that's why what you're about to learn is so incredibly powerful for you. Because if you can follow some simple rules, you'll discover that it doesn't matter whether the market is rising or falling. You'll have a strategy to profit in any market condition. You'll never need to worry about buying the top of the market, because our one number strategy is going to ensure that you're buying the right stocks, not the whole market. And that provides you with literally monthly profit opportunity. And you'll also see that by using our unique investing plan, your portfolio is protected. It's almost automatically shielded against bear markets, against huge losses, and you'll see why and how in this report. But you may be curious, at least, about why we've chosen $1 million as our goal. Why not 2 million, right, or 10 or 100? Because if you're 40 years old or older, you're likely facing what Forbes magazine calls the greatest retirement crisis in American history. One that will leave millions of people poor in their later years. And here's why. First and foremost, a Fidelity investor survey discovered that baby boomers right now face a $24,000 annual income gap in retirement. That means imagine your life today on $24,000 fewer dollars per year. That's not a good thing to think about. Second, 65% of Americans have $50,000 or less saved for retirement. That's the average portfolio right now in America, about $50,000. The problem is that based on just some rough math, relatively simple math, you need at least $780,000 in pre-tax dollars just for retirement. And that doesn't account for things like buying a home if you're a younger investor or if you still have kids to put through college. It doesn't account for things like vacation or travel in your later years. So when you consider that the average standard of living is just about $52,000 per year, and you bring in that other statistic of facing a $24,000 annual income gap, that means you're going to end up below the poverty line at $28,000 per year if you don't have enough money saved for retirement. And in addition to the vacation or travel there, we also had medical expenses, which is the fastest growing category, government healthcare notwithstanding. It's the fastest growing money suck for senior citizens today. So if you want to live a longer life, you need more money to be able to afford it. That's kind of the secret to life, I think. But when you add it all up, it's pretty simple to see why we've set our initial goal at $1 million. And once we get there, then we can look at making 2 or 3 or 5. The problem is that, like many people, you probably don't have $1 million, and you may not be anywhere close to that number. So, obviously, your first question is, well, how am I going to get there? Well, you have to understand how big of a problem is this, and it's what we call the retirement gap. And for most people, that retirement gap is over $700,000. So right away, we know we're a long way from $1 million. So how are we going to reach that goal? I'm going to be blunt here. In order to reach that goal, you must be willing to invest in individual stocks again. Put simply, you don't have the same low-risk choices to balance your portfolio that you did have 5 or even 7 years ago. That means you have to be willing to accept some risk, that some risk is necessary. But in this webinar, in this training tonight, I'm going to show you how to limit your risk so that you'll never be in danger of losing it all when you learn how to use our approach. And the last point here is that we all should know that time is working against us now. We don't have those 50-year models that we used to have to be able to put money away and let it grow, even at a small rate, so that we could reach our goals in 10 or 20 or 30, 50 years. Well, most people probably are closer to no years until retirement, or 5 years or 10 years. So if you think stocks are dangerous, I want you to understand that they're actually less dangerous than bonds, CDs, savings accounts, etc. All of those have crashed far worse than the stock market did. At least the stock market recovered. They have not. Savings CD rates down 86% in the last 5 years. U.S. Treasuries, that safest investment on the planet, they've collapsed by 50%. Yet the stock market is now going into new high territory almost every single day. And you may be wondering, okay, so how is that possible? And in part, it's because the market is no longer just a buy and hold environment. It doesn't mean buy and hold is dead. It isn't. But high-frequency trading, computer algorithms, computer-based trading, they've all created a trading environment on Wall Street, not an investing landscape, which was what we had 20 years ago, which means that you, as an investor, have to make some simple changes, which means embracing individual stocks with a specific set of rules inside of a well-defined plan. So that will help you to avoid being left behind, or worse, sort of relying on the government in your retirement years. And I want to help you prevent that from happening. So with a quick introduction, my name is John Hutchinson. I am the creator of the Millionaire Blueprint and the investing strategy that I'm about to teach you. I'm also a published author. My book, The Wealth Shield, How to Invest and Protect Your Money, can be found on Amazon.com. And I'm also one of the publishers here at Traders Reserve and MainStreetInvestor.com. But I'm best known as a wealth building expert and strategist who helps people restore their retirement dreams while protecting wealth from risky or get-rich-quick schemes. So enough about me. Let's dive in for you. Now, we were talking about stocks a couple of minutes ago and the need to embrace some changes. And one of the first things that I continue to see is that despite the rebound in the stock market, most investors today are still making serious mistakes with their money and their investing. And it's the key reason that most folks are still having a difficult time getting their portfolios to grow consistently, especially with the markets making new highs. And there's a reason for that. And that reason is that because most people are still following the same investing models of the last 15 years. We already discussed buy and hold, but also this diversification idea between stocks and bonds, whether you're defensive, cautious, or bullish. Here's the reality. Over the last 15 years, that model, that typical investor's model, has returned less than 3% per year. And even the best of forecasts forecast that you'll get up to about 7% per year in the near future. And you might think that 7% per year sounds pretty good until you take a look at this chart. Because at 7% per year, you could put $10,000 every single year into the stock market, and it would take you 30 years to reach $1 million goal. That's if you put $10,000 into the stock market every single year, and if you get that 7% per year every single year. Not only are there too many ifs in that scenario, but let's be honest, most investors simply don't have 30 years. But if you can follow some simple rules, and what I'm about to teach you tonight, in 8 years or less, this could be your portfolio. That's $1 million in about 8 years, and I expect you to be a little skeptical, but the purpose of this training tonight is to show you how to do it, because that's what you need to know. How do I do this? So it's first done by making one simple change in how you think about your portfolio, and that change is to think in terms of time. Investors who want to achieve their goals and still believe in the retirement dream, we already said it, you can't just buy and hold. Again, that doesn't mean that buy and hold is dead. It isn't. But it's those buy and hold models that are projected to return that 7% per year. And you've just seen that that's not going to get it done for you. Today, we'll teach you how to use short-term investing in stocks, not day trading, but short-term investing in stocks, to accelerate returns by compounding your gains every single month. Not every year, every month. And that will grow your portfolio faster than you thought possible. Now, to do this, and again, remember we're thinking in terms of time here, you use just part of your total portfolio. You don't have to bet the farm. You don't have to go all in. You can use just a part of your portfolio, depending upon your total capital available, up to about 10% to get started. And that will still allow you to get explosive growth of your money and still keep your overall portfolio safe. But that brings me to an important lesson. And this is one of those moments you may want to write down. The key to successfully growing your portfolio is determined by increasing the annualized rate of return on your money. And what I mean by that, and I'm going to give you a negative example of it first, is this chart here goes back over the last 15 years, and you've heard, no doubt heard, the pundits pounding the table about buying index funds, buying index funds, buying index funds. Here's the S&P 500 index fund. Over the last 15 years, if you had put $10,000 every single year into an S&P 500 index fund, your annualized rate of return was 2.9%. And that includes years where the market went up 25, 30%. It includes years where the market went down 50%. But your overall rate of return, it means your money grew less than the rate of inflation over the last 15 years. That doesn't get it done for you. But that's the problem. You see that the market is making new highs, and you probably think that this means you're raking it in if you bought and held an index fund, but it's not true. This is where buy and hold. Now, keep in mind that if an index fund is part of your overall investing strategy, then that's fine. But whereas for most people it's the entirety of their strategy, you can see why folks never make their goals. And in fact, what actually happens is your rate of return, the longer you're in an index fund, your rate of return begins to decrease. The only way you actually make it to $1 million is by increasing your annualized rate of return. So instead of 3% per year, we're going to show you how to change that model, because at that rate, it would take you 60 years to reach $1 million portfolio at that 2.9% per year. So along with savings accounts, CDs, bonds, and now even index funds, you're probably wondering, how the heck are we going to get to $1 million portfolio? Well, the answer is something that we call hyper compounding. And you can do this safely, you can do it consistently, you can do it reliably in your portfolio, regardless of whether your portfolio is an IRA, a Roth, a regular brokerage investing account. If you can buy and sell a stock, then you can use this hyper compounding strategy. And I'll remind you again that this is not day trading. This is short-term investing. You'll see what I mean when I get to a couple of examples here in just a little bit. But what is hyper compounding? So it is, at its simplest, a strategy to increase the annual rate of return on your money by compounding your gains based on time. In other words, I want to be able to compound my gains every month, every quarter, and every year. Well, in this case, I'm focusing on the every month, because the more frequently you compound your gains, the faster your money grows. So let me demonstrate the power of hyper compounding for you. Let's assume you start with $10,000. and you get an average return per month from your investments of 4% per year. 4% per month, not per year. After 12 months, that $10,000 would now be worth $16,000. That's an annual return of 60%. Now, this is linear math. is intended to demonstrate how fast your money can grow when you do this. So that 4% per month is the compounding strategy. Now, here's the hyper part of that strategy. If you follow the same plan for a second year, starting with that $16,000 and still generating that 4% return per month, your money has now grown to over $26,500 at the end of the second year. And your annualized rate of return is actually now over 78%. And in just 2 years, notice that you've also more than doubled your money, but you never had to add a single penny to your account or to your strategy here. That's the goal. That's the idea behind hyper compounding. Now, in our program, and we'll get to some of the specifics here in just a little bit, we target anywhere from 2 to 8% monthly returns. Sometimes you're not going to get a lot from the market. You have to be willing to take what the market will give you, and that means finishing on the lower end of scale. Sometimes all of the stars align and the markets are in your favor, and you can capture a much larger gain, and I'll show you an example of such a month right now. This month of December in just a little bit. So let me give you a quick overview of the plan. You've seen sort of the idea behind hyper compounding, why you need to embrace this kind of a strategy. Let me share with you some of the specifics of our plan and our rules, and then right after that I'm going to introduce my special guest tonight so we can do the right stocks. So this is what we call our power profit portfolio. It allows us to start with a small capital base, generally 10% of your portfolio, or if possible $10,000. We have had people start with as little as $2,500. And again, IRA, Roth IRA, any type of brokerage account, if you can buy and sell a stock, you can follow this plan. The first step, once you've created your capital base, or what we like to call our capital base, the next step is to divide that capital into 10 capital groups or buckets. This is specifically if you're starting with, so say you're starting with $10,000 as your capital base, you would divide that into 10 equal buckets of $1,000. Each bucket then would hold one stock at any given time. So the maximum number of stocks you would hold is 10. So again, you can see that it's not something that's going to take hours and hours of time, because you're not looking at 100 companies. You're just looking at 10. That's it. You only need to manage 10 stocks at any given time. And what this actually does, this little two-step that we've just gone through, these 2 steps we've gone through of determining your portfolio base as about 10% of your total portfolio and then dividing that capital into 10 equal capital groups, what it's done is it reduces your overall risk exposure. It ensures that no single stock can take down your portfolio or wreck your money. And I'll show you why when we get into the rules in just a little bit. But just some of the general concepts behind the plan and why this is relative, that's as simple as it gets. You don't have to get any more detailed than that. If you have a $100,000 portfolio, you take 10% of it, that's $10,000. You divide that capital into 10 capital groups, and you're buying a basket of 10 stocks every month, taking your gains at the end of the month and moving on to the next month. That's the plan. That's the concept of how to target hyper compounding gains on a monthly basis. So our concept of the power profit portfolio begins with that short-term investing in stocks. Now, we can also invest in medium terms, longer term time frames, etc., but we want to start with the short term, because that gives us the fastest growth of our portfolio. Most of the time, our stocks in our program, they typically close by month's end. Some of them will run 60 days, some of them will run closer to 90 days, but in general, we're trying to close as many of our trades as possible with specific targets by the end of each month. And then what that allows us to do is to start creating that positive short-term return that we can then compound the next month. And I know I've said it a number of times, I'm sure I'll repeat myself again and again and again, this is not intended to be day trading. These are stocks and sometimes ETFs that we are holding from 1 to 3 months. It's what's called short-term investing. Now, our gains are compounded monthly instead of annually. And our goal is to generate between 2 and 8% returns each month. That would give us about a targeted annual rate of return of 80%. And when you're compounding that then year over year over year, that's the strategy. That's the idea behind turning $10,000 into $1 million in about 8 years. Because if you can follow that plan month after month, that's about how long it would take you. It would take you up to 8 years to go from $10,000 to $1 million if you are averaging about 5% per month, which is the midpoint there between 2 and 8%. We've actually been doing better than that in our program. We've been averaging 6.6%, so we're a little ahead of schedule. That's fine. We know sometimes we're going to be ahead, sometimes we'll be a little bit behind, but so far we're sitting a little bit ahead of schedule on that. What you'll discover is you can make more money faster with just part of your portfolio using short-term investing with these goals that I've just laid out for you here in mind, and never risk losing it all. Like I said, you don't have to bet the farm. You don't have to go all in. You just start with a small part of your money, and that's it. And let that money grow month after month after month. Now, to keep this relatively simple, one of the second biggest mistakes, and as we walk from the plan into the rules, one of the second biggest mistakes I see is what I term as hope is not a strategy. In order to achieve your financial goals, you need 3 things. You need a simple, repeatable plan to come out ahead. You need easy-to-follow rules that don't take a lot of time. And you need a smart way to protect your money. But you may wonder, why is it that most people do lose money? And I want to share with you a quote that was once shared with me a number of years ago, and that was that people lose money because they don't have triggers to quit. Now, at the time, the person who was sharing this quote with me, he and I were on a flight to Las Vegas, and we were talking about gamblers, and he told me, he said, I have 2 triggers, a profit trigger and a loss trigger. Whichever one I hit first, I pull that trigger and leave the tables for the night. And a little later, we were talking about investing, and he said it's the same principle when you invest. You must have triggers, but most people don't have a loss trigger. They have a hope trigger. They just hope the stock will come back. And they don't have a profit trigger. They just hope the stock will keep going higher. And that's, frankly, the recipe for disaster. Hope is the recipe for disaster. It is exactly what wrecks investors' money. The key to any successful trading strategy is to use what we call decision triggers, specifically to remove emotion from the equation. Now, just like everyone else out there, when I get a winning trade, yes, I want to be able to celebrate that moment, sort of jump up and shout, woohoo! But the key to being able to reach that moment is to be able to make a decision that's favorable to you. The best decision you possibly can make. And that's what we call decision triggers, because what they do is they help you to remove fear, greed, and hope from the equation so that you're making the best decision you possibly can. In our case, when you learn to use profit and loss triggers to automatically, or to establish your profit target and your risk in advance, you'll automatically secure investment wins and protect yourself from a big loss. And the reason for that is because with these triggers, your decisions are made before you ever commit your money to the stock market. This is the part of the plan we call the rules. And in our program, the Millionaire Blueprint, we use what we call our 20-10 rules to short-term investing. Now, the 20 and the 10 are our decision triggers. 20% as a profit trigger, 10% as a loss trigger. So let me show you how that works when you put it all together. First, reviewing the first 2 steps in the Millionaire Blueprint, in the short-term investing plan, was to determine your capital base, 10% of your total portfolio, or $10,000, then divide that into 10 capital groups, right? Now, on top of that, we add the rules, and the rules are a profit trigger at 20% above our entry price. That can be a sell limit, it can be a price alert, it can be I see the price get hit and I take my gain. But what it is the decision allows you to do one of 2 things, either to take your gain and then repeat this process with a new stock the next month and compound your money, or you can let that gain run, that winning trade run with some protective triggers behind it. But essentially, you're forcing yourself to allow yourself to take a gain and never ever give back a gain. And like we see so many times, I'm sure we've all had this happen, right? One day you're up 30%, the next day the stock craters and you're down 10%. You don't know what happened or how it happened or why it happened. All you know is you went from earning, being ahead to being in the hole. That's what the purpose of a profit trigger as a decision trigger is to prevent you from giving back a gain. The next step is to set what we call a protective loss trigger, and we set that at 10% below our entry price. This is, in essence, a capital preservation tactic. In other words, you're not going to win every single trade you make. It doesn't happen. It doesn't happen for us. I don't know of anybody that it happens to. Nobody bats 100%. We bat about 75%. We could do a little better, but nobody bats 100%. In the trading world, and if they did, they wouldn't tell you. So I certainly wouldn't tell you, but nobody would tell you. But the point behind that loss trigger is when you're wrong, save as much capital as you can for the next time when you're right. That's the purpose behind that loss trigger, is to preserve capital, because for whatever reason, the original rationale for making that particular trade no longer exists, and you need to get out of the way to protect your money, preserve as much capital as possible, and move on to the next trade or the next opportunity when it comes along. That's the purpose behind the loss trigger. It prevents a small loss from turning into a big loss. How many of you out there lost significant amounts of money in 2008, 2009 because you didn't have a loss trigger in place? You didn't have a way to literally stop the bleeding, preserve maximum capital. Here you're preserving 90% of your capital, and then wait for more favorable conditions. How much better off would your portfolio be today if you had that protective loss trigger at your disposal back in 2008 and 2009? So essentially what we're going to be teaching, or what we're teaching you here, is that by using this plan, don't be afraid to hit singles and doubles. Winning in the markets is really just like playing baseball. You can score more often and win more games by consistently hitting singles and doubles rather than swinging for the fences at every at-bat. And I'm like everyone else. I love the home run trade. But that's what? 1 out of every 1,000 trades? Frankly, I'd much rather be hitting singles and doubles, racking up 20%, 30% gains on a regular, consistent basis, and be able to compound that money to grow money faster rather than wishing and hoping for that one big trade. So in a few minutes, what I'll be doing here is telling you how you can get your hands on the Millionaire Blueprint, which details all of the investing plan and the 2010 rules in greater depth than I've taken you here. I've taught you the basics. They aren't all that difficult, but I give you more examples in the program, and I'll detail that for you in just a little bit. But there's an obvious piece that's missing right now, and that's the right stocks. And to talk about that, I want to introduce the Millionaire Blueprint's investing expert, Jamie DeLugish. If you don't know Jamie, he's a 25-year veteran of the stock market and investment professional. Holbert Financial Digest previously ranked as Rational Investor a #1 newsletter. He currently writes for investment websites, which include Traders Reserve, MSN Money, MarketWatch, TheStreet.com, and others. And he's the author of a forthcoming book called Manipulators, Beating Wall Street's Earnings Game, which is due out, we hope, in March of this year. So, Jamie, welcome, and thanks for joining us tonight.
Hey, John. Thanks for inviting me tonight. I appreciate it. I'm really excited to be here. You went over a lot of really great pieces of information, and as you pointed out,
I don't know if your audio is working. I can't hear you.
Check. My audio's on. Hello? Hello? Can you hear me now?
Still can't hear you, Jamie. So obviously we have a technical difficulty here, folks. Jamie, what you may need to do is to log out, log back in, reset your computer. I'm going to start the one number process, and then as soon as you log back in, I'll just tap you back, and you can start from wherever we happen to be. So, folks, while Jamie gets things going, I'm going to keep us moving right along. And fortunately, we've done this presentation enough that I think either of us could fill in for one or the other. So, to start with finding the right stocks, we use a process that we call searching for, if you will, the one number. What Jamie does is every month, at the end of each month, he runs a computer-based algorithm which ranks stocks based on a model he has built and perfected over the last 10 years. That model allows him then to review stocks by individual sectors so that he's avoiding overexposure, and he's also not overweighted in any particular market capitalization, small caps, medium caps, large caps, etc.
John.
Then he applies a qualitative analysis process to re-rank those stocks into a top 10. Generally, each month then he'll select the 5 best stocks. And what he's doing is he's looking for one number to identify which stocks he wants to buy and which stocks to avoid. So, yeah, Jamie, I'm not sure why I can't hear you.
Okay, I'll just assume that they...
Without me being able to hear you, Jamie, I can't advance the slides for you.
Yeah, go ahead. Just keep going.
Hang on just a second. All right, so Jamie, I'm just going to click the slides. You talk. I'll guess.
Okay, so sorry for that curveball. Technology and all of its wonderfulness sometimes fails us. So we'll do the best we can. It sounds like everybody else can hear me. One thing I wanted to add before we got started here and talking about the right stocks is how this all came about. I've been in this business quite a long time. I have a really strong historical track record of picking the right stocks, and I did an extensive analysis 2 years ago to try to figure out were there any commonalities between all of the stocks that appreciated much greater than the market and everything else, or stocks that didn't or underperformed the market. And sure enough, this one number that we're talking about was that one commonality that we uncovered a couple of years ago, and to great effect. And it really is the driver of the Millionaire Blueprint program. And so we'll explain here what the PE gap, or the one number I'm talking about, does for you. Specifically, it identifies stocks that are going to be in demand by the market. Because if you think about it, investors in general, especially the institutional investors, the ones that drive market valuations because of simply the dollars that they control in the marketplace, they're buying profit growth, and they want to buy profit growth at a cheap price, or as cheap a price as they can. And so the PE gap identifies that for people. A gap occurs between the PE ratio and the earnings growth rate. It's really that simple. So that when the PE ratio is greater than the earnings growth rate, we have an overvalued stock, excuse me. And when the PE ratio is less than the earnings growth rate, we have an undervalued stock. Those are the ones we want to buy. The wider that gap, the better the opportunity. So much so that when we find these stocks using the PE gap methodology, they can trigger 15 to 30% returns in a very short time frame. Typically, our holding period is anywhere between 30 and 90 days. And I am going to try to, there we go. We're moving to the next slide. Thank you. Here's an actual recommendation of a stock using the PE gap methodology. Manitowoc, ticker symbol MTW. At the time we recommended it, had a PE ratio of 16, so the PE ratio is less than that earnings growth rate of 19, giving us a PE gap of -3. So again, when the PE ratio is less than the earnings growth rate, we have an undervalued or buying opportunity. And you can see by looking at the chart, we recommended this stock right at the first circle at the bottom there. And within 30 days, we were able to capture a 20% gain. So it's a very powerful tool. Again, as John said, not every stock that we choose is going to appreciate by 20% or more, but a lot of them do, which is why we can deliver the monthly returns that we'll show you at the end of this presentation that we've been doing since I became the advisor of the service in October of 2013. So the real quick lesson for PE gaps is that you want to buy the stock when the PE gap is negative, and that occurs when the earnings growth rate, again, is higher than the current price to earnings ratio. Why is that? Well, investors want earnings growth. That's what they're trying to capture in the marketplace, and if they can buy it at a discount, utilizing PE ratio as their guide, then they have a buying opportunity. And when the PE gap is positive, we want to avoid those stocks. These are the stocks you want to sell. And for the more aggressive investors, these are the ones you'd want to short sell. And that occurs when the earnings growth rate is lower than the current price to earnings ratio. So the wider the gap between the PE and the growth rate, the better the opportunity for short-term gains. I have a feeling John can hear me now. The slides are moving perfectly. Thank you, John. So step one, here are 3 numbers that you need to do this at home on your own. We'll use American Airlines, ticker symbol AAL, to help you find these numbers. I use Yahoo Finance. You can use any financial portal, but I tend to find Yahoo Finance to be the most reliable. I go to the earnings estimate page, and then from there I find number 1, the current stock price, number 2, the earnings estimate for the current year, and number 3, the earnings estimate for the next fiscal year. Once I have those 3 numbers, I can do 2 really quick and easy. If you know division, simple division, you're all set. And you can actually do this yourself, starting by calculating the price to earnings ratio, which is simply the price of the stock divided by the current year estimate of earnings. In the case of American Airlines, it's 51.4 divided by 572 to give you a P/E ratio of 9. Next, you're going to calculate the earnings growth rate. That's next year's earnings divided by the current year earnings. In this case, that's $8.42 divided by 572 to give you a nominal 1.47. You make that a percentage, or 47% earnings growth rate. Now you've got the 2 most important numbers, and you simply compare those 2 by taking the PE ratio minus the earnings growth rate to give you the PE gap. So in the case of American Airlines, again, that's the PE ratio of 9 minus 47, or a PE gap of minus 38. And as you probably have heard by now, American Airlines is one of those stocks that did very well in 2014. I think it doubled. In fact, I know it doubled in value, and it's going to continue appreciating just based on the fundamentals of the company. So the PE gap here is negative, and we've got a buying opportunity, which when we recommended this stock on October 1st, 2014, we were able to buy it at $34.50 per share. Using the Millionaire Blueprint 2010 rules, again, remember we're calculating a profit trigger and a loss trigger. So your profit trigger is simply that opening price multiplied by 1.2, or for American Airlines, it's $34.50 multiplied by 1.2 to give you $41.40. That's your profit trigger, or your ceiling. Then you enter your loss trigger, 10%, take that entry price times 0.9. In the case of American Airlines, $34.50 times 0.9 gives you $31.05, and that's your loss trigger. All your work now is done. All you have to do is place this trade, let it run to its conclusion. In the case of American Airlines, it still continues to run. We had a little bit of a dip in October thanks to the Ebola scare, which, by the way, triggered the decision analysis that John mentioned in the beginning of the presentation, where that 10% floor was breached, triggering an analysis of the stock that told us that something other than fundamentals was driving the share price, and therefore we were not going to close this trade. And we did not, and for good reason, because quickly that Ebola scare dissipated and the stock continued its trajectory, which it is still on today. We're up over 50% on this stock, on our way to a 100% gain in American Airlines. Another recommendation, also coincidentally in the airline industry, Southwest Airlines. We're using this to help you calculate the PE gap. So for Southwest Airlines, the PE ratio at the time of recommendation was 15. The earnings growth rate was 17.5. Now here we didn't have nearly as wide of a negative PE gap of 2.5, but it was still negative, and the company is undervalued. We recommended the stock in October of 2013, and we want to buy that stock at the current price once we did this analysis, because the PE gap is negative. Again, using the Millionaire Blueprint rules for calculating your profit and loss triggers, you take that opening price, or your entry price, of $14.56 in the case of Southwest Airlines, which, by the way, today Southwest Airlines is a $40 stock. So that just tells you the power of this methodology. Your profit trigger, entry price times 1.2 giving you a ceiling of 1747 on the stock, and your loss trigger, take the entry price times 0.9, 1456 times 0.9 is 1310, and that's your loss trigger. Again, you have a band, you have a profit, you have a loss, place the trade, let it run to its conclusion, and once again, I already spoiled this one by telling you it's a $40 stock today, but when we made the recommendation in October, we didn't know that appreciation was ahead of us. We wanted our 20% gain in the 30 to 90 days. That's the entire goal. That's how we deliver the monthly compounding that John talked about earlier in the presentation. It's not just airline stocks, by the way, for the skeptical out there. We have recommendation upon recommendation that have hit. In fact, John, we closed, I believe it's 2 trades in December, non-airline based stocks that hit their 20% targets after buying the stocks on December 1st of 2014. So this happens over and over again using this methodology. Here's the current portfolio, as a matter of fact. And what's nice about this is you see that the PE gaps range from anywhere of a high of minus 128, which proves our point that the wider the gap, the better the opportunity. TSE is a stock, one of those stocks that is up 20% since we made the recommendation in December. So every month, the beautiful part about this, and some of you may be wondering, well, does this work in a bear market? Yes, it works. Doesn't matter what's going on in the overall market. A market is made up of individual stories, and always, no matter where we are in the economic cycle, where we are in the market cycle, investors are going to demand profit growth, and buying that profit growth at a low price is always a smart strategy. I'm going to turn it over to John now. He's going to share some of our performance history.
Actually, Jamie, now that I can actually hear you, and
okay.
What I want to do is, Ken asked just a couple of questions ago here, how do you calculate the earnings growth rate? So I'm going to go back a few slides before we go forward so that you can walk through the calculation steps one more time. Let me get you back on the step 1, and let's just walk through the 3 numbers, the calculations, if you would, please.
Absolutely, and I apologize for going fast. Some of you, this might be basic. Some of you, this is entirely new, so I'll try to go a little slower this time. On American Airlines, the 3 numbers that you're looking for are your current stock price, your earnings estimate for the current year, and your earnings estimate for the next fiscal year. Now, to the specific question of how do you calculate the earnings growth rate, you take that earnings estimate, the next fiscal year, divided by the current year earnings estimate. It's a simple division that gives you a nominal price. In this case, we take 842 is our earnings estimate for next year, divided by the 572 earnings estimate for this year, giving us a nominal 1.47. Convert that into percentage terms to tell you your earnings percentage growth rate. And that's it. It's about as simple as my mentor in this business, he said, the fry cook at Denny's can figure this stuff out.
Hopefully the fry cook at Denny's is not making trades for us, but I think a couple of things that I want to point out on not only the...
do the calculations. Let's be clear about that. There's a lot of work that goes into identifying these trades, but...
So for Ken's purposes here, if you're looking at this, the 2014 estimates are the full year earnings estimates for the companies. You can find this information on pretty much any financial portal. Yahoo Finance has it most readily and easily available. So that's where these numbers are taken from. The 2015 estimates would be the next year's earnings estimate. So that's what Wall Street expects the companies to earn. So the key here, and the reason that this works consistently, is because we are identifying undervalued companies. Now, we're not talking about value companies. We're talking about undervalued companies relative to their future growth. That's what Wall Street will be bidding up, if you will. Just like American Airlines. When we first discovered American Airlines, it was sitting with a PE gap that was somewhere around -60. It had a price to earnings ratio that was about 7. And we're talking about 2 months ago, back in October. So it's not that long ago, and we've seen this time and time again. Companies that have lower PE ratios, but their earnings growth is so spectacular that Wall Street's going to come along and bid them up. The Manitowoc trade was a great example. It was a smaller PE gap, but that stock exploded for over 50% gains in just over 45, 50 days. So these types of trades are out there regularly and consistently. Now what I want to do is, if you'll bear with me on this slide just for a second, this is essentially this is how everything works all together, just for the month of December, just so you can sort of see how we do things and why it's successful. So we had 10 short-term investments, 10 short-term recommendations. And so the tickers that are listed for you there, the entry prices would be as of the market open on December 1st. Now, the reason we enter our trades on the first trading day of every month. Sorry, it was December 2nd, if I remember correctly. We enter our trades on the very first day of the trading month. We're not market timers. We're not trying to outguess or outwit Wall Street here. What we want to do is we want to get our money in the market and working as quickly as possible once we've identified the right companies to be buying. Now, every one of these trades will not work out in our favor. We already know that. That's why the rules will help to protect us and to allow us to take gains. So Jamie mentioned that we've already had a couple of our trades, LAD, that's Lithium Motors, and TSE Trinseo. Both of those have already hit their 20% targets this month. Kate Spade, we closed out with about an 8.5% loss. We told everyone just to exit that one. You know what? It went down and it didn't recover well enough, and so we preserved our capital on that one. But what you can see here when you're looking at each of the returns on each of these individual recommendations is there's a good mixture of returns here. You've got a couple of small gains. You have a couple of small. There's some that are breaking even. Not every trade is going to go from 0 to 20% in 1 month. Remember, our holding time is 1 month to 3 months, so up to 90 days. So some of these stocks we may be carrying over into January. We've already bought in, so we can just sit tight, let them germinate, let things take root, and look to close them out in January or as late as February. But all told, if you had started with $10,000 in the month of December, you would have actually, this is the right side of this slide chart shows you the effect on $10,000. So you can see sort of real world how this can work. You would have closed out 2 of the trades. I already told you, LAD, TSE at the 20%, and 1 trade a little inside of the 10% loss trigger. So it was about 8.4%, 8.5%. But you would have started with $10,000. Your actual invested capital, based on the entry prices, would have been $9,691.80. That would have left you with a little over $300 cash. Now, the next step is one of the parts that I do to make this somewhat realistic for you. We estimated an entry commission of about $6.95 for each of the 10 trades. So that's why you see commission of $69.50. You're going to pay commission every single month. On the trades that you have to make every single month. So we have net cash left over of about $238, just over $238, and the actual total account value of $9,900 there. At the end of the month so far, based on where these stocks have been trading, based on the trades that we have closed, our ending portfolio value was $10,166. It's a $500 gain from where we started. And our net cash is obviously still the same. Now, in my ending portfolio value, I've already accounted for exit commissions. So there's an additional deduction of $69.50 on the back end. So this is as real world as I can make it, which means that in just 1 month, that's a total return of 4.9%, which is right in line with our targeted rate of return of averaging around 5% per month. And these are, since the inception of this program in August of 2013, these are the monthly returns that we've generated. And yes, we've had a couple of months like January and March of last year where we had negative returns of 1.5% and 1.7%. Both of those months, however, those returns, those months still had stocks that went on to hit their 20% targets, and both of those months were months where the overall indexes lost significantly more than we did with our 10 stock selections. So over the course of the last 15, 16 months there, it's a 6.6% monthly average. That's well within our 2 to 8% returns per month. And that's how you get on when you do this month after month, that's how you get to that $1 million portfolio. So we're going to stop in just a couple of minutes here and do questions and answers. I know there are a number of questions. I tried to answer a couple as we were going along for Ken and a couple of other folks, but we'll bring Jamie back in here in a couple of minutes to do Q&A. But this is when you put all of this together, the plan, the rules, the right stocks based on that one number. That's how in 8 years or less you can reach that $1 million portfolio. And we've already talked about why it's so important, but what I'm much more concerned with is giving you access to the entire Millionaire Blueprint program. As I said at the top, it's the only step-by-step investing plan that's specifically designed to create millionaires. That's why it exists. And our Millionaire Blueprint program it contains all three elements you need to be successful. It contains the plan, it contains the rules, it contains the right stocks, just as we've shown you here tonight. Now we're going to give you an invitation to join the program. We have just a few seats left for 2015. And I'll get down to the simple details for you here, but this is how we do how the program works. This is our sort of our step-by-step execution plan. As I said earlier, Jamie makes new monthly trade recommendations at the end of each month. We enter those trades on the first trading day of the month. Now for January, our entry will actually be January 5th, which is a Monday. And the only reason for that is because Friday being, because the Friday coming after the holiday, it's easier to just wait for the Monday so you get a full trading week in there. Sometimes the first day, just is a little too, you don't get the best prices necessarily on that first day of the year. But we also have a number of people joining us, so we're going to be doing some live training on the first weekend here of the new year so that everybody's on the same page, everybody's ready to rock and roll for 2015. Sorry, Dick Clark. But the key here is we want to get everybody in on Monday the 5th and give people more than enough time to get ready to go. So outside of that, every other month, it's always on the first trading day of the month. We recommend entering at the market open. The only reason we make recommendations at the market open or for the market open is to ensure that all of our members get in. In other words, all of our members can execute their entry trades. If we were giving you limit prices, there's no guarantee that everyone would be able to execute the orders. So that's why we use market orders. That's for fairness across the board for all of our members. If you are one of those folks who watches the market a bit more regularly and want to use limit orders, you're more than welcome to do so. Obviously, once you get the trades and you know which stocks we're trading, you can make your own, you can use your own technical analysis, if you will, to find an entry point that you like, and many of our members do that. But for folks who are working folks who don't have a lot of time, the reason we run the program the way that we do is so that it's accessible to every level of investor. So you can set your trades the night before, and they will execute for you the next day, and then you're in, and then you follow the triggers, you follow the trade alerts and exit alerts that we give you. That's essentially the function of the rules of investing. And then when we hit our 20% triggers, we'll usually tell you to take your gains. So close your trade and take those gains and let them roll over and compound the next month. So it's that simple. That's how we do it. We run the program as a 60-day trial for $79. No trickery here. You get complete access to everything in the program. And I'll give everyone the link here in just a second. But the reason that we use this 60-day trial, to be perfectly honest with you, is we don't know if it's right for you. we don't know if short-term investing is right for you. So we want to make sure that you have a way to test out a couple of months worth of recommendations, see the impact, see the effect, know whether they're going to work for you. I'm going to put a box up right now in the over in the chat area. You can click that button to get to the 60-day trial. That will help you sort of get started right away. And one more second here. I'm just making sure everybody has access to this so you can get going right away. You can use either of the links here. Any of these will get you in there right away. So we still have this number needed to be updated. We have about 82 slots left for 2015. So there are about 240 of you on here. So we're going to be open until January 1st. We're going to close registration for 2015 on January 1st, or for January 2000, whatever. You know what I'm talking about here. So let me tell you what you get. First of all, this is what the program includes. I said you get complete access to everything. You're going to get trades for January. You'll get trades for February. In that space of time, over those 60 days, you can expect that you'll probably close 1 or 2 winning trades each month. Over the first 60 days, you will probably have to close 1 or 2 losing trades in the first 60 days. Remember that our winners win more than our losers lose. That's why this is successful. We are operating on a 2-to-1 risk-to-reward ratio. All of this is taught to you in our what is now called our $1 Million Portfolio Blueprint. We have a new version for 2015 coming out this week. So if you join now, you'll be one of the first to get it as soon as it comes out on New Year's Eve. We also get the monthly stock selections direct from Jamie. These include your PE gap generated stocks, so you know which 10 stocks to buy for the short-term investing portfolio for the new month, and for every month thereafter. You'll also get access to our Millionaire Blueprint members only website. Everything you need is in one simple, easy to access place. So monthly reports, all of our updates, all of our weekly reviews, our weekly analysis, strategy session recordings, all the special reports, etc. All of that is located right here. We're also going to be doing, actually this is going to be a one-day live Millionaire Apprentice Boot Camp. This essentially is going to be a training evening that we will be doing later this week with all of our new members, so that everybody knows exactly how to execute the first 10 trades of 2015. We're going to be taking on over 100 new members for the month, so we want to make sure that everybody knows how to get started and is set up for success right at the start. As a member, you also get trade alerts and regular updates. Your regular updates come every Tuesday and Thursday nights at 7 p.m. Eastern Time. Essentially, they contain a quick overview of what's happening in the markets. Any trade alerts will always give you an action to take if there's something that you need to do, whether a decision trigger has been reached, whether we want you to close a trade, either at the loss trigger or at the profit trigger, whether we hit a profit trigger and we want you to hold that trade longer. We'll tell you what to do with our actions to take. And then also our Saturday review comes out every week, obviously on Saturday. In that Saturday review, Jamie will tell you essentially what's happening with each of the individual stocks in the portfolio. We do all the math for you, so you know which stocks are ahead, which are behind, and you know how well each of these positions is stacking up for the next week, for the week ahead. You also get 2 bonus reports, our Advanced Profit Strategies report, our $2,500 plan report. Advanced Profit Strategies, again, for people who have a little bit more time, teaches you 2 very simple strategies. First is your risk reduction strategy. That shows you how to recapture your trading costs and how to eliminate nearly all risk in every trade you make. Yes, all risk. And it also has our active investor rules, which teach you how to capture larger gains from a winning trade by just doing one thing. The $2,500 plan, I've told you before earlier in the presentation tonight that some folks have started with as little as $2,500. This plan shows you how to go from $2,500 to $10,000 so that you can have those 10 $1,000 buckets as the true starting point. So it takes about 13 months to get there. This plan lays out exactly how to do that while still following the Millionaire Blueprint stock selections. You'll also get our, which will be new for 2015, our capital management spreadsheets. These spreadsheets do all the work for you. They do all, essentially, they manage your 10 positions. They let you know what your overall gains are. Just as I sort of showed you on that December slide where I calculated out the portfolio value for the month, the capital management spreadsheets will do the same same thing for you. You also get access to us via the Millionaire Hotline email. This is a special email box that we've set up. When you have questions, when you need help, you don't email our customer service. You email Jamie or me directly. We watch that box Monday through Friday, 9 a.m. to 5 p.m., and occasionally on the weekends, and especially whenever we're releasing our monthly stock selection report. So when you need help, this is your lifeline for instant support. You email us directly, and we will get back to you typically within an hour or less. So that's it. Again, it's a 60-day trial for $79. You get complete access to the entire program. After the 60 days, you can continue on in the program for $79 a month, or as soon as we get into the end of February, we'll give everyone an opportunity to upgrade at a very special price, which is usually 33% discount. So for the annual, you can upgrade to an annual and save about 1/3 of the total cost. So let me start reading off some of the questions, and give me just a couple of seconds to catch up. Jamie, you can open up the mic again, and hopefully all is well for us here. And let me kind of back up and start pulling some of the questions here. Tom asked the question earlier, is it advisable to start with $20,000 if you have more than $10,000 to start with? Tom, you can start with any amount you want. The key with the short-term investing portfolio is you only need to take a portion of your overall portfolio. So if you have a larger portfolio to work with, you can start with more, but the critical step is to ensure that you divide that initial starting capital into 10 equally weighted capital groups, and then go from there. So how long in the car loan in the first place? Most car loans right now are running about 7.5 years now, all of a sudden. So let's see. Okay, thanks, folks, for having a good time. Did I miss something? Is 4% times 12 now 60? Yes, 4% compounded monthly is 60%, Greg. And the reason for that is most people are trying to do linear math, and they're multiplying 12 times 4, which equals 48. That's not compounding. That's the 60% is a compounded return, which means you started the first month with $1 and you made 4%. So the next month you have $1.04. So you make 4% on that, you now have 1.04 times 1.04, so you now have $1.16. So your money grows much more rapidly when you're compounding monthly in that vein. So rather than linear math here, that's compounded math. Brian, actually, this is a good question for you, Jamie. What price range of stocks do you buy?
Well, that is a good question, and we're agnostic. The most important thing is the PE gap, and if there's opportunity on a stock that's trading for $1,000, we'll buy it. If it's trading for $2, we'll buy it. Now, that's an exaggeration. Most stocks tend to be between $50 and I'd say $100 a share. We do own Whirlpool in December at $175 a share, I believe, was our entry price.
186.
186. So it really just depends. Again, the price of the stock is not what's important. It's capturing value based on the PE gap methodology.
Next question here is, why not do weekly options? And the simple answer to that is we don't know when the 20% targets will be reached. It can happen. It can happen quickly. It can happen. I mean, we had an example last year in December. A stock that we recommended went up. Actually, wound up being the target of a takeover. They were bought by another company, and the stock went up and hit its 20% target in the first 5 days of the month. So there's no way to effectively use options in that regard, because if if you hit, you're getting lucky. Whereas by having a 20% profit trigger on our stock trades, we don't need to worry about using options. The plan, I mean, it's like do what you do best, and this is what we do best. But thanks for the question. I appreciate that. It's a good question. Let me move along here, get through the whole part where I couldn't hear you, Jamie. So, yeah, just a quick clarification on the American Airlines trade and what we do every month. Jamie and I effectively watch the markets for you so you don't have to. With our recommendations, we keep our eye on the technical, on the fundamental, on the news, on the earnings, on the sectors. So when things go wrong, not only are we here to tell you what's going wrong, we're also here to help you understand what best to do about it, what you can do about it. With American Airlines, and I think this is a very, very important lesson, we do not use stop-loss orders. We do not use stop-loss orders. The simplest reason why is if you have a group of 200 or 300 investors who all put in the same stop-loss order, what do you think is going to happen with the market makers? I mean, that's like a big red bullseye, right? So what we do instead is we stick to our triggers. We use them as decision triggers. If a 10% loss trigger gets breached, we will either tell our investors or our traders or our members, stick with this trade, here's why, or close this trade, here's why. Now, I already showed you Kate Spade, which was K-A-T-E, Kate Spade from December. We told our members to close that trade at about an 8.5% loss. The 10% decision trigger was breached. We don't see a favorable trading environment for that stock in the near term, so it did not make sense to keep that trade alive, so to speak. Better to save 92% of our capital for next month and be ready to roll that out at the beginning of January with a stock that has a chance of getting its 20%, rather than letting it wallow in the mud with the stock that's going nowhere. American Airlines, completely different story. And this is why you need to understand how the media manipulates the emotional aspect and response of the markets. The early part of October was all about the Ebola crisis. Just two healthcare workers. That's all it took. 2 healthcare workers taking commercial flights in the United States. And within hours, every single airline stock was literally cut by 20%. You can look at the chart on American Airlines. At the time it was trading, I believe we were trading somewhere around $38 or $39 a share on that already back in the beginning of October, $35, I'm sorry. And that stock went all the way down to 28 and change, 29, like that, just in 3 days. That was it. But if you looked at the news, you understood that this was a media-generated crisis. This was not something that was going to negatively impact American Airlines. And at the same time, oil prices were collapsing. So you have this double-edged sword, literally double-edged sword here. On one hand, you have this media crisis of Ebola. On the other hand, you have this oil price crisis, which actually helps American Airlines. So that when we looked at the earnings and we showed you how to do how to calculate the earnings growth rate a little while ago, those earnings estimates for next year of $8.42 are up substantially from where they were just 90 days ago. Just 90 days, that's the full year earnings, $8 a share for American Airlines. Like 90 days ago, those earnings were down in the $7. So that's how rapidly that stock has been repriced. Now, when we put all of that together, yes, that 10% loss trigger was breached, and breached by a fair bit. But we told our members to stick with that stock, and we gave them a reason why. So just to give you some clarification on why when we don't just make recommendations, we're helping you understand the reason you're making the investment or holding an investment in a stock. And for the most part, frankly, we've been right. And Jamie does a really good job of staying on top of all of the stocks. There have been a few times where we've cut a winner a little early. Probably could have held out for an extra 5 or 10%. But if you're pulling in 20% gains, I don't think you're going to be too upset about that. So let's move on to a couple of others. So if after a month the stock is still negative, would you roll that over to the next month rather than sell? Jamie, what's the approach that you like to take when we have a stock that's just not going anywhere as we come into the end of the month and get ready to go into a new month?
So when we make the recommendation initially, the expectation is we're in it for 30 to 90 days. Kate Spade, you mentioned, hit its 10% decision trigger, and so on something like that, you have to weigh the potentiality, I guess, of that stock actually doing what you initially thought it was going to do versus cutting your losses and moving on, which is what we ultimately did. As much as we have quantified everything that we do here, you're still making. There's still, the human element in this, and so, my preference, I guess, is I guess it just depends on the situation. What's going on in that industry? I'll kill one of the questions for you here. Somebody asked about diversification, and awesome question. That's actually probably the most astute question I've seen on any of these webinars. For whomever asked that question, way to go, because it's a really good question, and it's a really important part of the puzzle here. So that when we're building, even though it's only 10 buckets that we're filling, I do purposely try to differentiate between industries and sectors for diversification purposes, and also by capitalization. So I can have some small cap stocks. I can have some large cap stocks. The story of 2014 was the Russell 2000. The small cap sector was way underperforming. That's changed in the last month. Well, if you were a subscriber with us in October and November, we were already positioning for a small cap rally. Because our PE gaps were flashing green on a lot of really wonderful small cap stocks. TSE is a less than $1 billion market cap stock that we captured a 20% gain on here in December. So market cap across sector, across capitalization is something that matters. And then as far as there's also diversification of time, so that if we're in a stock that's moved sideways for the 60 days, and there doesn't appear to be a trigger that's imminent to catapult the stock higher, we'll close it out and look for opportunity elsewhere. So that's a real long way of saying, I guess it just depends on the situation.
Okay, thanks. And no, Chris, we do not. Thank you for asking an amusing question. I enjoyed that. So do you trade stocks that have earnings coming up, and or do you hold through earnings? Yes, and yes. Oftentimes, Cecil, we will find that earnings can be a positive catalyst for the movement in the price of a stock. It is not the only, we're not making earnings trades here. It's not the only reason that a stock is going to appreciate it, but it can absolutely be the jet fuel, so to speak, that makes a stock move rapidly. So we do hold, or generally will hold through earnings. If for any reason Jamie finds some negative news or has a reason for exiting a trade prior to earnings, as he has done on a few occasions, again, he'll make a rational call and tell you why he wants to exit a stock just prior to an earnings announcement. Somebody had asked a little earlier about an actual trade. American Airlines is an actual trade. This is as real and as recent as it gets. This was a recommendation that was made at the end of September 2014, so just a couple of months ago. The entry date was October 1st, 2014. The market open price that day, we actually had a pretty favorable day there, was $34.50. And so again, following the basic rules, we would have set a profit trigger at 20% above that, or $41.40, and a loss trigger at 10% below that. So that would have been $3.45 below. So about 31.05 would have been your loss trigger. And based on when the Ebola crisis hit, that's where we started to see this initial downtrend right there. And then you can see it got down to a low of about 28.70-ish. And then within 3 days had recovered, 5 days, had recovered all the way back to our entry. That's also the deep V in the middle of October. Of the overall stock market, but this is the real world example. We hit our 20% profit target on October 31st. Happy Halloween! And at that time, what we told our members was there was not a reason to exit this stock. So we moved this stock to what we call our medium-term bucket. Now, that's another element to the program which we'll introduce you to once you're a member. But what that allows us to do is to now continue riding the stock for an additional 90 days, if necessary, for another 20% gain on top of our initial 20%. So we would have repriced our target at a 40% profit target, which would have been, that was up around $48 a share, and that 40% is still calculated based on the original entry price of $34.50. So we recalculated and we moved that to our medium-term bucket, and you could see it took just over to the beginning of the December here, and sure enough, it's now hit our 40% target. I think our actual return on that one right now is about 48%. And we've now moved it to a long-term bucket. We're going to hold this for a profit true target of $69, which would essentially be a double from where our original entry price. This is a very good example of what Jamie likes to call the escalator move. These are the types of stocks you want to find, and these are also the types of stocks. If we went back to the Manitowoc chart, you'd see something very similar. That these are the types of trades that the PE gap finds on a regular basis. So let me take you back to you can see how that looks somewhat similar. You can see that within that stock moved 50% up, 50% in 60 days. Now, it did not go on and hit 100% return, but just that quickly. It doesn't take that long for us to get these types of gains using this process. So some great questions out there, and that a number of you were asking about holding beyond, or trailing stops or things of that nature. We generally don't use trailing stops in up to the 20%. When we're above the 20%, we may consider it from time to time if we're in a stock that has enough volume to support a trailing stop mechanism or strategy, but in essence, what we're looking for is letting the stock market do the work for us. Let those winning trades run, cut those losing trades early. Sherry, the 2 training sessions, actually it's going to be 1 training session, but I'm going to hold it on 2 separate days, most likely one on Friday at noon Eastern time, and or maybe a little early. I may hold it actually at like 11 a.m. on Friday, and the other one will be on Sunday, probably in the early evening, just like tonight's. So those will be the live training sessions. There will be 2, so members can attend whichever one fits their schedule best. So Sam asks, do we multiply 1.2 with 20% trigger? No, Sam, you multiply your entry price by 1.2. That gives you your essentially the price at which you would exit to get that 20% profit trigger. Can you increase the monthly return if you use trailing? So that was one of my questions there. No, Clyde, we do not short stocks. Quite simply, the reason we don't short stocks is shorting is not accessible to all investors. So we are long only. You can use the positive PE gap side of the equation to potentially short stocks, but understand that the time factor, the time the time of that trade, it tends to be much shorter. It tends to be days to a couple of weeks. Whereas with our negative PE gap trades, the trades where we're looking long, those tend to run for a longer period of time, 30, 60, sometimes up to 90 days. Eddie, will the 60-day trial start on 1/5? No, the 60-day trial starts right away, Eddie. But you're still going to have enough 60 days there to get 2 full months of the stock selections, and you'll be able to get more than enough flavor to know if you're going to continue on in the program. Once you do 2 months of this, if you get 5 or 10 or 20 stocks total over those 2 months, that's more than enough to know that if you can keep up, if you're able to make the trades, and if you're able to, obviously, if we're able to generate a return for you, etc. So, Chris has a nice little point here. The problem with programs like this, subscribers are dependent on those running the programs. They don't want you to know how to do it without them, or they won't make ongoing subscription money. Thanks, Chris. Unfortunately, I've just taught everything that we teach to our subscribers. You can take the PE gap calculation and run it on any stock on the U.S. stock exchange that reports earnings. So, unfortunately for your comment, you're wrong. Because we actually teach people how to do this. We teach you. You've already learned how to segment your portfolio. You've already learned the money management, the risk management, the trade management, the rules. I've taught you the rules. I've given them to you. So you can take the rules and apply them on your own. So you're not dependent on me. What you are dependent on is a community of traders who follow a plan, who follow a set of rules, who select individual stocks. You're not dependent on anything. We actually teach and continue to teach people how to find their own stocks. We're actually launching another program later this year, which is designed to do that using big board stocks and large cap stocks. So I appreciate what you're saying, but given that we've shown you the plan, shown you the rules, and shown you how to find these stocks on your own, you could actually take this and go do it yourself. So, but thanks I appreciate the comment. Art has a good question. How do you handle the system during a strongly down market? Jamie, very briefly.
Well, how do we handle this in a down market? The same way we handle it in an up market. We're looking for opportunities to make money. Most of December, the market was actually negative for the month, and up until we're up 5% this month. So it really doesn't matter what the market does. July was another example where the market was down, I believe, 3%. We made almost 200 basis points. I think it was 150 basis points, or a 1.5%. So, you know, we could talk at length, and I won't, for bear markets. I mean, there's so much that goes into that. You know, we're not long only 100% blindly bullish and all of that kind of stuff. We do use ETFs from time to time to get short exposure in our 10 buckets if that's deemed appropriate given the macroeconomic analysis that is a component of choosing the right stocks that we haven't really covered here in tonight's webinar. But you know, if there is a bear, the best part about the bear market, or any bear market, is it creates huge money-making opportunities thereafter. Every bear market I've seen and studied, really since the Great Depression, have been wonderful buying opportunities. So, yeah, they're painful to go through and everything, but you really shouldn't be afraid of them. You just shouldn't. So.
Nope. All right. So I think we're in. Did you pick up the coach question there? Yeah,
I
you
did.
Okay, great. Yeah.
I almost had to throw up doing it. It's a horrible stock.
All right, so let's see. Just a couple final questions we'll do here, and then we'll call it an evening. Trade notifications come by email, and beginning in January, we'll also be doing text messaging. Text messaging will be limited to exiting a stock. So if we don't need to be texting you that often. So the only thing you know when you're entering the stock is always the first trading day of the month. So that's pretty much a given. So the only thing you need to know is when to exit. So we'll be using SMS to provide exit alerts for the stocks that we recommend in the month. So there we go. That's the Millionaire Blueprint program. Once again, the link is in the box, the pop-in box, the admin notice box. It's a 60-day trial for $79. You can get in now, and we look forward to working with everybody. We already have about 25 people who have joined us for tonight, so that is great. Good to have all of you along. Those who want to learn how to do this on your own, yes, you'll be able to utilize this to start learning how to put stocks, your own lists from screens or from other programs you may use. So, Jamie, I want to thank you for taking time for joining me tonight. I will see you tomorrow at noon Eastern Time to do the last one for 2014.
Thank you, John.
And for all of us here at Traders Reserve, I hope everyone has a happy New Year, a safe evening on New Year's Eve if you're celebrating. But we look forward to having you join us. And if you do, or if you have, stay tuned, because tomorrow Tuesday, you'll begin hearing from us as far as getting registered for the live training that we'll be doing later this week and this weekend. And then your first stock selection report will be out a little this weekend as well. So one last question just came in on the private line here, so I want to address it. When each month begins, our objective is to fill all 10 buckets. So if you are starting new in January and we carry over any of the trades from December, yes, you will most likely be told to go ahead and buy those trades, those stocks from December, because if you saw the chart earlier, you saw that most of them were basically at break even. It might have been up 1 or 2%. So there wasn't a huge premium over the original entry price being paid. So any stocks that we carry over from December, plus those stocks that we add for January, which will probably be 3 to 5 stocks for the month of January, will give you your 10 baskets to fill for the month of January. Then as you roll into February, any of the trades that we exit in January will refill those baskets in February. So that's how the program will work during your trial. That's what you can expect. Again, already closed out 2 solid 20% gainers, did close out 1 small 8% loser this month here in December. The rest of our trades are still running and still running just fine. So for everybody here at Traders Reserve's Millionaire Blueprint, this is John Hutchinson saying, have an awesome night. Have a great year this year, and whether you work with us or not, we do hope that you reach all that you are attempting to reach with your financial goals. So have a great night, and for those of you who have joined, thank you, and we look forward to seeing you in our training webinars very soon.